Hi there everybody and welcome back to another stock analysis video. Today we are going to be analyzing the company BorgWarner, a company that I've never heard of before. However, it was brought up by Russell Hively where he said, have you ever looked at BWA? So let's take a look at this company, analyze their fundamentals, and come up with a target share price in accordance to their cash flow and shares outstanding. So with that said, let's get started with this analysis. Coming over here to the dividend summary, guys, BWA actually does have a dividend yield of 1.81, which ends up being 17 cents per share for an annual payout of 68 cents. The payout ratio is around 17.04% with a 5-year growth rate of a little bit small though of 4.33%. Now, these two things right here seem okay. However, what isn't okay, at least when it comes to a dividend perspective, is the fact that their dividend growth is 0 years. However, taking a look at the dividend history, we can see that they haven't cut their dividend in the slightest within the past 10 years. However, when it comes to increases, they're not that sustainable, right? Or at least they're not that consistent, right? Ever since 2017, they increased this dividend to 17 cents and then they have kept it the same up until today. So when it comes to an increase in dividends, guys, that's not necessarily something that you want to look at because you want a company to continuously increase their dividend. Ex-dividend date passed as of May 31st. Payout date is actually coming out on the 15th of June, and they pay their dividends quarterly. Coming now to the calculator, we got the ticker symbol of BWA, market cap of almost $9 billion, PE of 13.37, which is pretty much just telling me that at the current share price of $37.50, this might actually be a pretty decent price to buy it at. But the PE is only one metric based off of the earnings. We're going to take a look at other metrics to come up with an even more accurate representation of what the company should actually be worth. Annual dividends per share, as we just saw, is 68 cents, and doing this dividend in accordance to the amount of shares outstanding that they have, this comes out to be $163 million being paid out in dividends every single year. And once we do this, and once we take a look at this in regards to the average for your 5-year free cash flow, they're left with almost $455 million in free cash flow, which is a payout ratio of around 26.38%, which is significantly lower than that of my 60% threshold that I like to buy companies when it comes to a secure dividend. Taking a look now at some fundamentals, so then of course net income 5 years ago of $440 million to 1 year ago of $537 million. That is an increase, guys, of 22%. And even though this is an increase within the past 5 years, if you take a look at this graph, ever since 4 years ago to 2 years ago, they shot up as of 4 years ago to 937 million, and then they just kept going down to 2 years ago of 500 million, and then ever since then they did go up. So unless they actually are able to surpass that 931 million 4 years ago, once we get next year's numbers, right, then this 5 years ago is going to get pushed back. We're going to get 931, and if it's lower than 931, then this is actually going to be a decreasing number. So understand that essentially in the future, unless they do more than $931 million in net income, this will be a negative metric. Looking now at the free cash flow, the lifeblood of the company and the most important out of all profit metrics, because cash flow, it is essentially cash from operations less your capital expenditures, and this is what companies use to pay out a dividend, to buy back shares, to pay down debt, and to just grow the business in general. So we got 5 years ago of $620 million to 1 year ago of $638 million. That is an increase, guys, a tiny increase of 3% with an average 5-year free cash flow of $617.6 million. So taking a look at this graph, guys, yes, this is an increase on the 5-year scale. However, again, those two numbers only give us a small look at what is actually happening here. Looking at the 4 and 3 years ago number, we see that from 5 to 3, they went down, right? And then from 3 to 2, they went up. Ironically enough, when COVID was happening, they went up, probably because their capital expenditures went down. So from 5 to 2, they went up by a significant amount. However, from 2 to 1, they also went down. So as it stands, at least with all of these numbers, it is a slight increase. However, you really do have to be careful because within the next couple years, well, this might actually be a decreasing or at least roughly around the same $650 million mark when it comes to the free cash flow. Now taking a look at the revenue, 5 years ago of almost $9.8 billion to 1 year ago of $14.8 billion. That is an increase of 51.42%. And well, this actually is a little bit interesting here because from 5 years ago to 2 years ago, they were essentially flat, right? They were essentially flat at around like the $10 billion mark. And then 1 year ago is when they shot up to around $14.8 billion. So what does this mean to the future? I don't necessarily know, but if I were to guess, people would probably not spend a lot of money on their products. I don't even know what their products are, by the way. I think they were in the automotive industry, but nonetheless, that's beside the point. If people tend to spend less because of the whole economic situation that we are in right now, then you can pretty much expect this revenue number to actually be probably above the $10.2 billion mark, but lower than that of the $14.8 billion mark. So you really have to take these outliers with a grain of salt. Now coming to some balance sheet numbers, looking at assets minus liabilities. You want this number, guys, to be going up, and of course you just want it to be increasing in general, right? You do not want this number to be in the red, because if you take a company's assets and their liabilities exceed their assets, then that means that they cannot cover their debts in general, right? So you want this number to be very, very good in the positive. And currently they're at $7.3 billion. And also, to give them even more credit, within the past 5 years, they have increased this difference of assets and liabilities as well, which is actually really, really good. They are significantly better off when it comes to their assets and liabilities, and if things were to go bad, they probably aren't going to go bankrupt. Average total assets around 13 billion, average liabilities around 7.4 billion, and doing this difference we get $5.7 billion. Now looking at the shares outstanding, a metric that companies tend to fail because, well, it is the one metric that people tend not to look at. Now I look at it, and I always tell you guys to look at it because it is important, right? This metric tells you if the company is diluting you as the investor. Guys, issuing shares is different than a stock split, okay? Amazon recently had a stock split. That means that essentially there was no difference in the company. However, just issuing shares alone without altering the share price, that by itself right there actually does dilute you as the investor. Now, when it comes to this company, BWA, 5 years ago of 210.8 million shares to today of 239.6 million shares, that is an increase of 13 2/3% on the 5 year. However, on the previous to the current year, this was actually a decrease, believe it or not, of 0.08%. So a really, really small decrease when it comes to their shares outstanding from 1 year to the other. It doesn't really make a dent on the 5 year scale, but from 1 year ago of 239.8 million to today of 239.6 million, it is a decrease of 0.08%. And lastly, looking at the cash equivalents, they currently have $1.5 billion in cash equivalents with an average cash of around $1.2 billion. Now time to make some assumptions, low, median, high, using 3 different factors: revenue growth, projected share buyback, and the required rate of return. Guys, for the revenue growth, I like to use Seeking Alpha's growth tab, looking at the revenue growth year over year, the revenue growth forward, and actually in this one that was pretty good because the revenue growth year over year and the revenue growth forward were significantly closer to each other than the ones that I have done this past week. So makes it a little bit better to come up with a conservative assumption between those two numbers. Predicted share buyback, we just saw the shares outstanding graph. I'm gonna make an assumption based off of that number. And required rate of return, I like to keep it flat 10% to match the S&P 500. So for the lowest assumption, guys, I'm going to say a revenue growth of 15% and a projected share buyback of -10. This means that they will continue to issue shares within the next 4 years. However, instead of a -13, they're going to bring it down to -10. This comes out to be, guys, a target share price of $73.28. For the median assumption, let's say a revenue growth of 18%, projected share buyback of 7%. This is now $82.99, essentially $83. And lastly, for the highest assumption, revenue growth of 21%, projected share buyback of -4%. This is now $93.82. Now let's adjust for debt. The way we do this is we take the cash equivalents, we take the net debt, we add those two together, we add that to the market cap that the calculator comes up with using the terminal cash flow value, and then we divide that by the shares outstanding to give us the target share price adjusting for debt. And as you can see right here, it actually comes down, which means that they have a lot more debt than they do cash. For the low assumption, it is now $67.69. For the medium assumption, it is $77.23. And for the high assumption, it is $87.89. Now, adding a margin of safety to this target share price after debt of 5, 10, and 15%, this puts me to buy this company between $57.54 to $64.31 for the low assumption. For the medium assumption, it is $65.65 to $73.37. And for the highest assumption, it is between $74.70 to $83.89. Guys, the current share price is $37.50. So, what does this actually tell us? It pretty much just tells me that based off of my assumptions that I have here, this is looking like a pretty good buy, assuming that I like this company's fundamentals, right? Does this mean that you guys should follow this? Absolutely not. And the reason is because all of these numbers, all of these target share prices are based off of these assumptions, right? For example, let's say that the person that asked me to look into this company believes that the revenue growth might actually be a lot more than 21%. This person believes that it might be around 30%, right? And they believe that the projected share buyback is going to actually be positive 1%. And let's just say that they also want a lower required rate of return of, like, let's say 7.5%. Well, now you can just see how much these numbers have changed based off of these assumptions, right? Now the target share price is almost $200. Target share price of adjusting for debt is $191, and the margin of safety is between 163 to 182. So it really just depends, guys, as to what your assumptions are. This is not financial advice. I'm just giving you guys the raw numbers that's publicly available when it comes to the graphs and my assumptions. That's why I have these calculators available for free. I have this one, the book value one, which is used for banks, insurances, and utility companies, essentially companies that don't have capital expenditures, and a REIT valuation calculator as well. So that way, if you guys have any companies that you want to analyze, you have all of these ones. So that way you know exactly what to pay for based on certain criteria, right? So I have these calculator, guys. I have them available for free. I also have a dividend tracking sheet as well. It's all in my calculators playlist, and there's videos on how to like set them all up and all that stuff. The links are in the description. You open up the spreadsheet, you come up here, you go to file, you make a copy, and you have your own calculator. Again, this is not financial advice. Make your own assumptions. Every investment is the present value of all future cash flow, so you should make your own assumptions. All I'm asking for in return, guys, is for free content on YouTube, as well as my new tech sites too, and these 3 free calculators and a dividend tracking sheet is just help me grow my channel. That's about it. Like, subscribe, comment, tell your friends, tell people who want to learn how to invest using a fundamental basis, especially nowadays, right? The market has fallen a significant amount, and people are probably crying right now because they don't know how to invest in a bear market. Well, when you buy a company based off of fundamentals, you actually like the company to be going down, right? Because you know why you bought it instead of just buying it for hype. So if you know people that want to learn how to invest, especially in a bear market, well, show them this video, tell them to subscribe, and just help me grow my channel. Now let's actually take a look at this company when it comes to a dividend, because, well, they do pay out a dividend. So let's say that you make the average US income $68,703. If you were to buy 1 month's income into this company, which ends up being around $5,725, this would actually buy you 152.67 shares. And at the current dividends per share, this would give you $103.82 annually in dividends, quarterly dividends of almost $26, and monthly dividends of $8.65. So, as it stands, it actually isn't that bad. However, guys, there are a lot of companies out there that give out a lot more annual dividends per year for the same amount, right? Also, you have to take into account that this company has not grown this dividend at all within the past like several years, actually, right, since 2017. So when it comes to dividend play, you know, they don't have a good track record of increasing it, which isn't good when you're wanting dividends, especially for cash flow. All in all, when it comes to BWA, thank you so much for the recommendation. It's kind of meh for me, honestly. I like that they pay a dividend. I don't like the fact that they haven't increased it since 2017. And overall, their metrics are pretty much mediocre, I guess you could say, right? Like the net income is kind of meh. Cash flow is also kind of meh. The revenue is the only thing that's positive. However, you have to be careful about what's happening in the future with that. Assets and liabilities looking fairly good. Shares outstanding is not looking good at all, right? They are increasing it. And they do have a lot of cash and equivalents. Not enough, though, to offset that net debt. But that is essentially why I'm putting it as like a not really interesting of a company, at least in my opinion. If you like it, don't let my opinion make that decision for you. If the calculator makes sense and if you just want to buy it, right, then by all means, you should do whatever you want with your money. That pretty much does it for this video. Like if you like, comment, subscribe. It really does help here with the algorithm on YouTube. As I said, you guys can follow me on my new tech sites. All link is in the description below, as well as a Let's Play channel. So if you guys want to follow me there, you can follow me there too. So with that said, peace out and be on the lookout for the next stock analysis video.